Ladies and gentlemen, Asian guy here. Something just leaked out of Morgan Stanley that changes everything. Someone inside one of the most powerful investment banks on Wall Street just broke ranks. They violated every confidentiality protocol to get this information into the wild. That doesn't happen by accident. That happens when someone is terrified. The document that crossed my desk this morning is a client advisory note. Internal Morgan Stanley communication dated 3 days ago. The headline is brutal. Quote, immediate liquidation of all silver positions. Recommended before month end, unquote. Not reduce exposure. Liquidate everything. Morgan Stanley doesn't panic. They don't issue emergency sell orders unless something fundamental is broken. For 2 years, they've been bullish on silver, but this note reads like a confession. Let me read the key passage. Quote, recent developments in physical delivery mechanisms suggest elevated systemic risk in silver markets. We recommend immediate position closure to avoid potential liquidity events, unquote. Liquidity events. That's banker speak for we can't get out when we need to. But here's what's disturbing. It's not just telling clients to sell. It's telling them to sell quietly. Quote, execute via dark pools to minimize market impact, unquote. They want clients to dump silver without anyone knowing. Why hide unless you're afraid that others knowing would cause the exact panic you're trying to avoid? The timing is suspicious. This comes exactly 48 hours after that massive arbitrage gap between Shanghai and New York. The $14 premium that proved the global silver market has split in two. Morgan Stanley watched that premium explode and something in their risk department broke. But here's what they're not telling clients. What got leaked from inside their commodities desk? They don't want everyone out because the price will crash. They think the entire settlement system will crash. When that Shanghai premium hit $14, it exposed what Morgan Stanley has been hiding. The arbitrage mechanism keeping global prices in sync is dead. It's been dead for weeks. The banks have been pretending it's temporary. The source inside Morgan Stanley says they've been getting desperate calls from clients who tried that arbitrage trade. They bought silver in New York at 75, thinking they could ship to Shanghai for 89. But the metal isn't moving. The logistics chain has seized. And it's not just China export restrictions. Morgan Stanley's commodity financing desk has been unable to source physical metal for 3 weeks. When clients want delivery, Morgan Stanley has to buy the metal, but it isn't there. This is why they use the phrase liquidity events. They're not worried about price going down. They're worried about being unable to close positions at any price. For a bank like Morgan Stanley, being trapped in commodity trades is bank killing. The document reveals something disturbing. There's a section about, quote, irregular settlement patterns in December contracts, unquote. My source says Morgan Stanley had big institutional positions in those contracts. When they expired, when delivery time came, Morgan Stanley couldn't find the silver. They had to scramble, pay premiums, raid other stockpiles. That scramble cost millions in unexpected fees, but more importantly, it exposed them to delivery risk they never expected. Here's where it gets technical. Morgan Stanley's risk models never accounted for delivery rates above 8%. That's the historical average. For decades, contracts expired with delivery rates between 3 and 8%. But December contracts? Delivery rates hit 27%. 27% demanded actual silver instead of cash. That's triple their worst-case scenario. Their risk computers weren't programmed for anything above 15%. And here's what's terrifying about that 27% number. It represents roughly 63 million ounces of physical silver that had to be sourced and delivered in a single month. 63 million ounces. That's 8% of global annual mining production demanded from a single exchange during what's supposed to be a quiet holiday period. The source tells me Morgan Stanley had to activate emergency protocols they haven't used since the London Metal Exchange nickel crisis. They pulled traders back from vacation. They authorized overtime. They even contacted competitors asking about metal swaps. This explains why they're telling clients to exit before month end. January contracts are about to expire. If delivery demand continues at December levels, Morgan Stanley might face default. But here's the dark part. This note went to pension funds, sovereign wealth funds, the biggest silver holders in their client base. They're begging their biggest clients to bail them out by selling before delivery pressure gets worse. The leaked document contains a section I haven't mentioned yet. It's titled, quote, Counterparty Exposure Assessment, unquote. This section reveals that Morgan Stanley isn't just worried about their own positions. They're worried about their counterparties failing to deliver. The note mentions, quote, irregular patterns in peer institution settlement behavior, unquote. Translation? Other banks have the same problems. When Morgan Stanley tries to source silver from other institutions, they're being told the same thing. Not available. Back ordered. The entire interbank silver lending market has frozen. The source tells me there was an emergency conference call last Monday. Senior risk officers from major bullion banks, JP Morgan, Goldman Sachs, HSBC, Scotia. The topic was coordination of settlement protocols, but the real discussion was preventing cascade defaults. Apparently, several institutions admitted they were struggling to source physical metal, not just Morgan Stanley. The problem is systemic, and when one bank fails to deliver, it creates a chain reaction. The entity expecting delivery has to scramble to source metal elsewhere, putting pressure on other banks. This creates a terrifying feedback loop. If institutional holders dump silver to help Morgan Stanley, where does it go? To the industrial buyers causing the delivery pressure, they're feeding their own problem. The document mentions, quote, enhanced volatility expectations in Q1, unquote. That's not normal ups and downs. That's expecting something to break completely. Perhaps most revealing is what it doesn't say. Nowhere does Morgan Stanley claim silver is overvalued. They never argue the demand story is false. Their argument for selling is purely based on systemic risk and settlement problems. But there's another section of this leaked note that's even more damning. It's buried on page 4 under, quote, regulatory consultation timeline, unquote. The source tells me Morgan Stanley has been in discussions with the CFTC about potential emergency measures. Emergency measures for silver futures markets. What kind of emergency measures? The document mentions, quote, temporary settlement modifications, unquote. That's financial speak for changing the rules in the middle of the game. When a futures exchange starts talking about settlement modifications, it means they're preparing to break promises. They're preparing to force cash settlement on contracts that are supposed to deliver physical metal. The source tells me these discussions began 3 weeks ago, right around the time Morgan Stanley's commodity desk realized they couldn't source the metal they needed. And if the CFTC is already discussing emergency interventions, what does that tell you about how bad this crisis has become behind the scenes? This is Morgan Stanley admitting the silver market is fundamentally broken. Rather than fix the system, they're running for the exits. The source tells me the commodities desk has been in crisis mode for 2 weeks. Emergency meetings every morning. Risk managers working weekends. Phone calls trying to source metal. Every day it gets worse. But here's what makes this leak truly explosive. The source says this internal advisory wasn't Morgan Stanley's first attempt to manage this crisis. 2 weeks ago, they sent a different memo to their largest institutional clients. That memo was classified. It never leaked. But it apparently contained even more dire warnings about systemic breakdown. The fact that this current memo leaked suggests someone inside Morgan Stanley believes their institution isn't being honest with clients about the severity of the crisis. Someone believes clients deserve to know they're sitting on positions that might be impossible to exit. The source tells me about a conference call that happened last Friday. Senior partners discussing reputational damage mitigation. They weren't just talking about silver anymore. They were talking about what happens when the financial media finds out about their delivery problems. Apparently, one of their biggest sovereign wealth fund clients has been asking uncomfortable questions. Questions about why their silver positions can't be converted to physical delivery. Questions about why premiums for actual metal are so far above paper prices. The source says this sovereign wealth fund specifically demanded physical delivery of their entire position. $50 million worth of silver. In physical bars. To be shipped to their vault within 30 days. Morgan Stanley told them it wasn't possible. Not at current market prices. Not with current logistics. Not with current anything. That conversation happened 10 days ago. 3 days later, the leaked memo went out recommending all clients liquidate silver positions. Coincidence? The source doesn't think so. They think that sovereign wealth fund call was the moment Morgan Stanley realized they were operating a fractional reserve system in a commodity that had suddenly become non-fractional. For decades, the silver market worked on the assumption that physical delivery was theoretical. Maybe 1 or 2% would actually demand metal. But when 27% suddenly demand actual silver bars, when sovereign wealth funds want 50 million in physical delivery, the theory breaks. The source tells me Morgan Stanley's vault inventory reports show something terrifying. They're supposed to hold approximately 120 million ounces to back client positions. But when they did a physical audit 3 weeks ago, they could only locate 68 million ounces. Where did the other 52 million ounces go? Leased out, sold forward, used as collateral, rehypothecated. The standard banking practice of using the same asset to back multiple obligations. It works until everyone wants their asset back simultaneously. This is why the delivery crisis isn't just about Morgan Stanley. It's about the entire structure of the precious metals market. Every major bank has been playing the same rehypothecation game. They've all been using the same ounces of silver to back multiple client accounts, multiple trading positions, multiple derivative contracts. The source tells me there's a section in the leaked memo that I haven't shared yet. It's in the appendix, buried in technical language. But it essentially admits that Morgan Stanley cannot guarantee physical delivery for more than 55% of their silver-backed obligations. 55%. That means 45% of their clients are holding promises backed by silver that doesn't exist. This is what a fractional reserve collapse looks like in real time. This is what happens when a commodity bank runs out of the commodity. And if Morgan Stanley is admitting this internally, if they're telling clients to sell before the system breaks, what are the other banks admitting in their internal memos? The source says there have been whispers about Goldman Sachs having similar problems. Whispers about JP Morgan activating emergency lending facilities. Whispers about HSBC restricting new silver positions. None of this is public, but the whispers are coming from people who know. And here's something that should terrify anyone holding paper silver positions. The leaked memo contains a section about, quote, priority liquidation sequences, unquote. That's banking language for who gets paid first when there isn't enough to go around. The source tells me Morgan Stanley has actually ranked their clients in order of payment priority should the physical delivery system collapse entirely. Sovereign wealth funds are first, government entities second, major pension funds third. Everyone else fights for scraps. If you're a retail investor holding SLV or silver futures, you're at the bottom of the list. You're the one who gets cash settled at whatever price Morgan Stanley decides is fair when they can't deliver what they promised. This explains the urgency of the sell recommendation. They're not just worried about current delivery problems. They're worried about a scenario where physical silver becomes completely unavailable for Western institutions. A scenario where paper contracts become worthless because the underlying physical market ceases to exist for international trade. The source tells me about another detail in the memo that explains the timeline pressure. January 15th. That's the date when several major industrial users have scheduled large silver purchases. Tesla, Samsung, solar panel manufacturers. These aren't financial speculators. These are companies that need actual metal for actual production. And here's the problem. These industrial buyers have been coordinating. They've been talking to each other. They know about the supply crisis, they know about the delivery problems, and they've apparently decided to all demand physical delivery at the same time. January 15th, they're going to stress test the entire system simultaneously. The source says Morgan Stanley knows about this coordinated demand shock. They know when Tesla, Samsung, and others hit the market, demanding immediate physical delivery of hundreds of millions of ounces. The fractional reserve game ends permanently. This is why the leaked memo talks about enhanced volatility expectations. This is why they want clients out before month end. Because January 15th is the day the music stops in the precious metals musical chairs game. And Morgan Stanley already knows there aren't enough chairs. But there's another layer to this crisis that the memo only hints at. The source tells me about something called cross-market contamination. When the silver delivery system breaks, it doesn't just affect silver. It affects gold, platinum, palladium, every precious metal that uses the same banking infrastructure, the same vault systems, the same settlement mechanisms. The source says Morgan Stanley's risk models show that a silver delivery crisis would trigger margin calls across their entire precious metals book. Gold clients would panic and demand delivery. Platinum contracts would face scrutiny. The entire system would unravel because confidence is the only thing holding it together. And confidence is exactly what this leaked memo destroys. When clients read that Morgan Stanley can't guarantee physical delivery, when they realize the bank is telling them to sell to avoid liquidity events, confidence evaporates. The very act of warning about the crisis accelerates the crisis. This is why someone inside Morgan Stanley felt compelled to leak this document. They know the memo itself is dangerous. They know it could trigger the exact panic it's trying to prevent. But they also know that keeping clients in the dark while the system collapses is worse than warning them about the collapse. The source tells me there's growing dissent inside Morgan Stanley about how to handle this crisis. Some executives want to quietly unwind problematic positions and hope the crisis passes. Others want to go public with the delivery problems and demand regulatory intervention. The leak suggests the second faction is winning, but regulatory intervention might be too late. The source says the CFTC discussions I mentioned earlier have stalled. Regulators can't agree on emergency measures because any intervention admits the system is broken, and admitting the system is broken triggers international confidence crisis that regulators aren't prepared to handle. Meanwhile, the delivery demands keep growing. The Shanghai premium keeps widening, and banks like Morgan Stanley keep bleeding physical metal they can't replace. The source tells me Morgan Stanley's internal projections show they'll be completely unable to source new silver by February 1st. February 1st, 6 weeks away. After that date, according to their models, any client demanding physical delivery will have to wait indefinitely. Not days, not weeks. Indefinitely. Because the global supply chain will have broken completely for Western financial institutions. This is what the second document apparently contains. The document that hasn't leaked yet. The document that contains Morgan Stanley's internal projections for what happens if the current crisis continues. The source wouldn't give me details, but they said the projections make the current leaked memo look optimistic. They said if the public saw those projections, if they understood what Morgan Stanley really thinks is coming, there would be panic buying of physical silver that would break whatever's left of the settlement system within days. And maybe that's exactly what needs to happen. Maybe the system is so broken that panic is the only way to force a reset. Maybe the only way to get honest price discovery in silver is to let the fractional reserve game collapse completely. The source tells me one final detail about the leaked memo. The recommendation to liquidate before month end isn't just about avoiding delivery problems. It's about avoiding something worse. Something the memo calls, quote, counterparty chain failures, unquote. When one major bank can't deliver silver, it creates problems for every institution that was counting on that delivery. When those institutions can't meet their own obligations, it creates problems for their counterparties. The failures cascade through the entire system like dominoes falling. Morgan Stanley isn't just warning about their own delivery problems. They're warning about a scenario where the entire precious metals banking system suffers simultaneous defaults, where contracts become worthless, not because silver isn't valuable, but because the institutions promising delivery don't exist anymore. This leaked note isn't about silver. It's about the breakdown of a 40-year system where paper promises substituted for physical reality. It's the moment when financial engineering meets immovable physical scarcity. The note concludes with language I've never seen from Morgan Stanley. Quote, clients should prioritize capital preservation pending resolution of current market structure inefficiencies, unquote. Market structure inefficiencies. The most polite way to say the market is completely broken. If they're telling clients to sell, if they can't manage delivery risk, what about other banks? JP Morgan, Goldman Sachs, all playing the same game? This isn't just a Morgan Stanley problem, it's systemic. But here's what the source tells me is the most terrifying part of all this. The leaked memo isn't the whole story. There's apparently a second document, a document that hasn't leaked yet, a document that contains Morgan Stanley's internal projections for what happens if the current crisis continues. The source wouldn't give me details, but they said the projections make the current leaked memo look optimistic. They said if the public saw those projections, if they understood what Morgan Stanley really thinks is coming, there would be panic buying of physical silver that would break whatever's left of the settlement system within days. This leaked note isn't about silver. It's about the breakdown of a 40-year system where paper promises substituted for physical reality. It's the moment when financial engineering meets immovable physical scarcity. If Morgan Stanley is right about liquidity events and settlement failures, then the price on your screen isn't the real story. The real story is whether you can buy or sell silver at any price when the system admits it's broken. The month ends in days. According to this document, that deadline isn't arbitrary. It's when Morgan Stanley expects the current system to stop working entirely.